As I mentioned, we've got, for our closing keynote presentation, Henry Cobbe, Head of Research at Elston Consulting, and he will be speaking about emerging market ETFs under the spotlight. Over to you, Henry.
Okay, good morning, everyone. I hope you can see my slides. Can you see slides as yet? Great. So I'm just going to run through these slides from the top. We've been asked to look at the emerging markets ETFs under the spotlight, and what we thought we'd do is to look at the three main drivers, the flows and the matrices that we use to evaluate emerging market ETFs and look at the more nuanced exposures. So first of all, looking at the drivers, we believe obviously there's three layers for including emerging markets ETFs within a portfolio. The first layer is the core, making sure that there's a exposure as part of your core from a portfolio construction perspective, including emerging markets as a return-seeking asset, a way of obtaining rewarded risk. Why have that core in place? And that's really a strategic view, and it's pretty typical for most multi-asset portfolios now to have a core and strategic allocation to emerging markets because of the demographic trends that we see in Asia and the rest of the emerging market world, and that rising share of global GDP that's being driven by the emerging markets. Increasing amount of global GDP is being taken up by emerging markets, and so including it inside a portfolio makes sense to capitalize on those trends. Finally is the tactical reasons for including emerging markets. Primarily it's the kind of risk on, risk off trade, and emerging markets typically associated with a higher risk return profile, and to adapt to what's happening in the market and economy. Secondly is dollar weakness. So dollar weakness is typically associated with emerging markets strength, because it's very hard to, in a dollar strength environment, it's very hard for any emerging market performance to deliver any headwinds, deliver any returns against that dollar strength headwind. So when we see dollar weakness, that's typically associated with emerging market strength. Third is the fundamentals. So corporate earnings. You have to remember that markets like China were first into the COVID crisis, also means they'll probably be first out. And so seeing that kind of corporate earnings recovery is great as a way of getting growth into the portfolio. But again, that only translates through for the international investor if you don't have a strong dollar currency background. Finally, the other reason for incorporating emerging markets is in this yield-hungry environment. We've got negative rates in the kind of developed markets. Having a bit more yield and income stream from emerging market economies, be it in dollar bonds or local bonds, is appetizing for the yield-hungry investor. So that's how we see kind of the inclusion of emerging markets. They're core to most multi-asset investment strategies for those solid strategic reasons. But obviously, we see a lot of movement tactically because of that risk-on, risk-off approach. Just a quick look at flows. So we first of all look at the equity ETF flows and then the bond ETF flows. Looking at equity ETFs, over 3 years, there's been about $64 billion flowing into emerging market equity ETFs, and that's takes total assets about 380 billion, and that's across 737 funds and 416 indices, and we'll segment those funds further down the track. Year to date, although there's been a recent pickup in the summer, there's still in aggregate about $37 billion of cumulative outflows, and the peak outflow was actually the 12th of June, and there's 2.2 billion withdrawn from emerging market equity ETFs. I think probably as investors we're very grateful for the recovery in asset prices, and so thank you very much, and took some risk off the table. If we look at the bond ETF flows, so much lower level of overall assets in bond ETFs at the moment. So over 3 years, we had 12 billion inflows into 54 billion cumulative AUM across 112 funds and 73 indices. And if we look at the year-to-date flows, it's about 3.7 billion cumulative outflows, with peak outflows being much earlier on the 17th of March, so right in the middle of the market panic when 1.2 billion was withdrawn on that day. Obviously, more recently, and you probably saw Tom's article on this, but there has been a lot more pickup in interest in emerging markets over the last month or so, over the last couple of months. And if you look at the rolling of 1 month flows, about 1.1 billion going into emerging market equities and 1.4 billion going to emerging market bonds. So definitely kind of in the green zone, and definitely seeing flows coming in the recent months. Next, so we've looked at the drivers, we looked at the flows. What about the matrix? So what we describe as an ETF matrix is almost like how to subcategorize different ETFs by their exposure and also by their index construction, so that we can actually get a more nuanced and targeted way of reflecting a particular investment review. Now, what I haven't done is mapped all 713 emerging market ETFs into this matrix. That would be a time for another day. But what I thought would be helpful to share is how we would do that in terms of how we would structure that matrix, and also where the providers sit in that matrix. So this is kind of core to what we do. And so if you imagine the bulk of the ETFs out there are regional or country specific and are typically core exposure or all exposure. So core exposure, things like the IMI index, where it's an investable index. It doesn't cover every single emerging market stock, but it just has the most liquid and investable ones, which reduces obviously the cost of running the index and therefore the fund. And then you also have the all stock indices, which obviously cover absolutely everything, where obviously there, as a result, the cost of running that index and fund is higher, the TR is typically higher. And if you think about the bulk of the assets are in this top left-hand corner, if you like, of regional, country, core, traditional exposure. Where we see the innovation is obviously frontier markets, but then also thematic type investments that you've seen from Han ETF. But then we also see then more different exposures. So ESG SRI is going to be able to particularly area of growth, particularly with the MiFID II rules that come into place next rule on that. But also what we call alternatively weighted indices. So if you imagine that your core indexes are capitalization weighted, there's a more opportunity for more nuanced exposures with alt-weighted indices, so factor-based indices, dividend-based, or capped sector exposure, capped indices. We also see the arrival of kind of research-enhanced indices. So this is almost like a systematic, active approach to index construction. This is where JP Morgan's been building out its core exposures. And we also obviously have the currency hedging question. So I think this is the kind of matrix thing, because if the investment association sectors don't really do enough justice to the ETF categories, and I don't think anyone's really helping kind of get this really nuanced ETF categorization, because there's so many types of index out there, so many different ETFs out there. But this is the kind of framework we look at. But bear in mind the bulk of the assets is in that top left, just regional core or country core. But where we see all the development and all the growth in product types is from ETF providers who are looking to create something a bit more nuanced, a bit more interesting, a bit more focused on a particular angle or exposure. And that's where we see these main kind of categories for product innovation and giving investors a more nuanced way and more nuanced tools of accessing and reflecting particular themes or exposures. On the bond ETF matrix, again, we kind of break it up into these different categories. So the exposures we have basically by credit quality, so aggregate, which is government and corporate, government inflation-linked, corporate, and high yield. So that's your basic differentiation. And most of the product build and most of the assets at present is in those core kind of government and corporate exposures. And that's sort of dominated by the big players. So again, where we see the innovation from other providers is looking at these other types of more nuanced exposure of alt-weighted bond indices to kind of defer that criticism that you're always lending to investing in the most indebted companies. ESG and SRI bond indices would be a particularly interesting area. Term-specific indices. So in the developed markets, we have a huge amount of choice in terms of investment term, whether one wants to invest in 3-year, 5-year, 10-year treasuries or corporates. There's lots of choice around term-specific indices. We don't have as much choice at the moment in emerging markets around term-specific. So expect a bit more innovation in that area. Obviously, a core choice is whether you're buying local debt or US dollar denominated debt from those issuers. And then obviously there's currency hedging question too. So I think this matrix is not definitive, but if I was putting together a portfolio for a client, it'd be like, right, for an asset manager or discretionary manager, saying, right, well, what nuanced exposure do you want in there? Where do you want to be on the interest rate curve? Where do you want to be on term? Where do you want to be on credit quality? What ESG policy, currency hedging? But that's where you need the more nuanced building blocks, and just the big core exposures. And that's, I think, where we'll see the product growth is in these more nuanced exposures. Just sort of looking at where the AUM currently sits, as I said, the bulk of it is in those kind of core building blocks. So if you look at the largest index exposure by assets is the MSCI Emerging Markets IMI. There's 4 funds tracking that, mainly all iShares, 70 billion AUM. Next down is the FTSE Emerging Markets, all cap China, including China, which is just one fund, so the Vanguard fund with 61 billion of assets. And third is the kind of rest of the pack is the traditional MSCI Emerging Markets. That's the all stocks kind of effectively index, which and that's 21 funds tracking that, 43 billion, and that's where X-Trackers, UBS, Amundi, Elixir, HSBC are all in that space. On the bond side, if we look at the index exposure, again, the largest is the JP Morgan EM Bonds Index as a core. 7 funds, predominantly iShares, 27 billion of assets tracking that one. Next down by exposure is the EM Global Diversified with some caps. And again, that's another iShares, 6 billion. And the third one after that is, again, a core Euro hedged index with 4 billion of assets. So although there's this proliferation of exposures, at present, the AUM focus is in those kind of core, sort of quite plain vanilla product sets. And so, I think as the market grows and matures in terms of ETF acceptance and ETF use, having those more nuanced exposures to reflect those more nuanced views is going to be becoming the norm increasingly. So that's a very quick skip through emerging market ETFs, both on the equity and the bond side, the drivers, the flows, and the matrices that we would look to categorize and subcategorize those ETFs. And obviously, there's more on our website on Elston Solutions. But really, it's over to the floor for questions.
Good stuff, Henry. I had one question just about sort of product innovation. Which EM ETFs would you like to see more of that aren't currently out there in the market, especially in Europe?
Yeah, so on the bond side, it's definitely ESG bonds is one area, because I think ESG is becoming almost like the new normal in terms of product sets. It's gone from being a nice to have to being a have to have, and that's partly regulatory and that's partly behavioral trends. So that's one area. I think the second area for me is term specific. I think for a lot of portfolios, particularly retirement portfolios, you want to be able to control the duration within an allocation, and so having some duration targeted or term specific buckets whereby you maybe got a 3 to 10 year and then a short dated, a long dated. I think that'd be a really interesting area on the bond side. So ESG and term specific on the bond side, that'd be really interesting. On the equity side, I think ESG you've already been touching on, but I think there's much more scope for some sort of smart screening, some alternative weighted ETFs, because I think there's an increasing question around the kind of whole size bias of cap weighted schemes that we've seen with the developed markets too, when you have a huge amount of concentration of returns and index weight in a number of big bellwether stocks. So I think kind of alternative weighted indices on the equity side would be a nice way of getting access to exposure without over dependency on the largest names.
Good stuff. Yeah, another one through just about fees. Have you obviously EM ETFs tend to be more expensive. Have you seen a trend down here, and how close are we to getting near like where core markets are?
Yeah, I think it's a really interesting point, because you think, well, why should it be expensive in a way? And obviously there's 2 reasons why. One is just the dealing costs of running across multiple, dealing costs on those exchanges in those markets. It's typically higher anyway than the large liquid kind of US European markets. And so I think I won't have if you look at what's interesting, if you look at the MSCI Emerging Markets, which has all the whole index in it, I think the TR is quite punchy at sort of 0.5, 0.6. But then if you look at the kind of the core exposure, which is almost all of the stocks, just takes off the long tail of smaller emerging market stocks, but is an optimized index effectively. That's then deliverable at 20 basis points. But what's interesting, there's still a huge amount of assets sitting in the iShares full MSCI Emerging Markets Index that hasn't moved across to the IMI index. So I think if you see 20 basis points as probably the lowest cost sort of EM exposure or fair value for EM exposure, that seems to be the kind of the anchor at the moment.
And what do you think about smart beta and sort of a more active play in emerging markets, has that been proven to deliver alpha more so than in developed markets? Is that something you've seen?
Well, if you're believing in efficient markets hypothesis, you should be very positive on the potential for alpha in less efficient markets. So, I think that would be expected, if you like. But again, it depends on the quality of the of that systematic approach. So, yeah, if you've got a smart beta approach, and I really refer to alternatively weighted rather than smart beta because I think it's clearer. If you're an alternative weighting scheme that is either looking to isolate particular factors or trends or exposures, as you are dealing with less efficient markets, there should, in theory, be scope for greater alpha from those strategies relative to their developed market counterparts.
Good stuff, Henry. Well, those are all the questions we had. Yeah, I'd just like to say a massive thank you for coming on and giving some insight there.
Great. Well, I hope it's helpful, and look forward to catching up soon.